Welcome to today's session. Today we are going to talk about capital gains and its implication. We are going to talk a little bit about advanced taxation as well. My name is C.A. Shoikotra and I have been associated with ClearTax for 5 years now. Today we have Rahul with me. Rahul, who is a qualified professional, is leading the income tax team of ClearTax along with me. And if you have any queries, drop them in the chat box, and Rahul will pull out the question and answer them. Now, uh, before we start the actual seminar, webinar, let's try to take a look at what are the topics that we are going to talk today. Firstly, we are going to understand what is a capital asset and what constitutes its transfer. Further, we are going to take a look at short-term capital gains and long-term capital gains. What makes a capital gains a short-term or a long-term? What are the tax saving opportunities for long-term capital gains, and what are the tax compliances that is related to capital gains? Now, uh, we are going to talk about what is a capital asset. Now, capital asset is any property of any kind held by a person. Uh, as of now, many people are under the notion that capital asset could be anything. Well, it can be a house, a flat, clothing, anything that we are considered as property. However, as per the Indian Income Tax Act, there is a stringent list of assets which can be classified as capital asset. For example, any items that we are using for our personal usage are not to be considered as capital asset. However, there are certain exemptions to it. Uh, what should not be constituted as capital asset? A car, a motorbike, a laptop, mobile, etc., etc. They are not to be considered as capital asset. However, there are certain immovable or other movable items which can be treated as capital asset. They are jewelry, works of art, paintings, etc. Shares, most definitely, debentures or bonds, most definitely, they are called as capital asset. So if you are selling those type of items, a flat maybe, or a jewelry in work of art, shares, bonds, etc., etc., then you will be subjected to a capital gains taxes. If you are selling car, bikes, etc., in that case, you are not subjected to any capital gains taxation. Now, capital gains actually occurs when you transfer a capital asset. Now, transfer has a very wide ambit of meaning. As of now, the common parlance is if you are selling a capital asset, then only transfer actually takes place. However, along with transfer, along with sale, if you are exchanging one asset for another asset, if you are relinquishing any right of that capital asset, in that case, capital gains arises. If you are redeeming any bonds or debentures at its maturity, then also capital gains uh, instance arises because it also constitutes transfer. So for sale, it's pretty much simple. You have you have an asset, you are selling it off in exchange of money. That is sale, and that definitely comes under the ambit of transfer. Exchange, if you have one particular asset, say you have a jewelry, and you are exchanging that piece of jewelry with another piece of jewelry, or whatever jewelry you have right now, you are exchanging it with a flat. In that case also, exchange happens or other transfer happens, and you will be subject to capital gains taxes. Now, if you are not receiving any money for that exchange, right? If you are simply going ahead and relinquishing the right of an asset, extinguishing the right of an asset, in that case also transfer takes place. So, for example, if you held shares of a company, right? If you are holding shares of a company and that company goes for liquidation, that company ceases to exist, you are not really selling off that shares of that company, right? However, those shares are ceased to exist. Whatever rights you held on that shares that are extinguished, that also will constitute as transfer, and you can be subjected to capital gains in that case as well. However, in most of the terms, what we have seen that if the company is going through a liquidation process, you usually suffer a loss. Now, having understood the uh, what constitutes an asset and what constitutes a transfer of that asset, let's come to holding period of an asset. Because depending on the holding period of an asset, whatever gains that you are earning, that is classified as long-term capital gains or a short-term capital gain. Now, the long-term capital gain and short-term capital gains differ, uh, how they are taxed, how the taxation is computed for these two types of capital gains. So, uh, in respect of long-term capital gains and short-term capital gains, the rate of taxation is quite different. Long-term capital gains enjoy also exemption if you are investing the gains into certain class of asset. Therefore, it is very important to understand the holding period and how does it impact. Firstly, the general parlance is if you are holding an asset for a period uh, no more than 36 months, then it will be treated as short-term asset. So again, you need to hold it a period not exceeding 36 months. Then it is treated as short-term capital asset. Therefore, if you are holding the asset for exactly 36 months, then also short-term capital gains will arise. But if you are selling an asset, if you are transferring the asset after 36 months, even after one day, then it would constitute it is a long-term capital gains. However, there are certain cases wherein the holding period has been cut short, and it has been cut short by a significant margin. For example, for listed equities and listed equity oriented mutual funds. Now, if listed equity, when I say listed equity, I mean to say they are listed in Indian stock exchanges. Now, if you are holding any listed equity or equity oriented mutual funds, then the holding period comes down to 12 months, right? So in case you are holding a listed equity or listed mutual funds, equity oriented mutual funds, and the holding period of them are a period which is not more than 12 months, it will be treated as short term. If you are holding them for a period exceeding 12 months, it will be treated as long term. Further, if you are holding any unlisted equity shares or immovable property, then the holding period has been brought down to 24 months. So, if you are holding a flat or a house, a plot of land, any unlisted equity, when I say unlisted, I mean to say they are not listed in any of the Indian stock exchanges. Now, if this is the case, if you are holding them for a period up to 24 months, then it is considered to be a short term asset, and any gains which results from transfer of them are treated as short term capital gains. Normally, short term capital gains are taxed at the basic slab rate, right? But in case of listed shares or listed equity oriented mutual fund, there is a special tax rate of 15% which gets applicable. Further, depending on the income slab rate that you belong, a surcharge may be applicable on that tax amount as well. Now, short term we have understood hopefully. Now let's come to understand what is a long term capital gains. Now, any asset which is any gains or any asset which is not a short term asset is treated as a long term asset. It's a very simplified definition of long term asset. Usually the tax rate for long term asset is 20%. However, for special cases like listed equity or listed equity mutual funds, the rate of taxation is 10% after providing a deduction of 1 lakh rupees on the gain amount. Right. Now, let's try to understand how this actually pans out. For listed equity or listed equity oriented mutual fund, we need to compute what is the amount, right? So let's say I have purchased a share XYZ Limited on 1st January 2022, right? By paying 10 lakh rupees. Now, on 1st January 2023, I am selling off that shares for a amount of 15 lakh rupees, right? So cost of acquisition is 10 lakh rupees, selling price is 15 lakh rupees, and my holding period is a little bit more than 1 year in this context. Therefore, whatever gains I have will be 5 lakh rupees, right? From this 5 lakh rupees, I will be deducting 1 lakh rupees, and remaining 4 lakh rupees I need to pay taxes at the rate of 10%, which will be coming to 40,000 rupees. Now, as you may have noticed, for an asset to be treated as long term, we need to consider the date of sales in the holding period. Further, if you are selling off a listed security which is not equity or equity oriented mutual fund, right? For example, debentures. In that case, the rate of taxation is 20% with indexation benefit and 10% without the indexation benefit. Now, indexation benefit is a tool, a mechanism through which you can uplift the cost of an asset. For example, if you have purchased an asset 10 years back or 15 years back, most definitely you would have paid a lesser amount as compared to today's price. Therefore, if we are to reduce that cost of acquisition, the cost of purchasing the shares, it would give us a skewed capital gains figure, right? Therefore, the government allows us to uplift the cost to match today's standard, and this has been done by indexation. The government every year issues a index point, and every year starting from 2001 to has a index point assigned to it. Therefore, you can simply divide the index point of that financial year in which you have purchased the asset and multiply with the index point of the financial year in which you are selling it, and you will get a indexed cost of acquisition. Now, by doing so, you could uplift the cost, increase the cost, and come to a reasonable capital gains amount. However, it is to be noted for equity or equity oriented mutual fund, no benefit of indexation has been extended. And the index point for the financial year 2001 and 2 is 100, and for 22-23 financial year, it is 331. Now, uh, let's talk about tax saving opportunities on capital gains. Now, tax saving opportunity is possible only in case of long term capital gains. Short term capital gains do not enjoy any tax saving benefit. And tax saving can happen using Section 54, 54F, and Section 54 EC. Now, Section 54 is extended in case if you are selling a house property and you are investing the gain amount in purchase or construct another house property. However, there are certain conditions attached to it. Firstly, you need to invest the gain amount to get the exemption. Secondly, in case you are purchasing a house or a flat, that house or flat need to be purchased within a period of 2 years from the date of transfer, the date of sale. If you are constructing another house property, in that case, the construction should be done by 3 years from the date of date of sale of that original asset. However, there is an option to go back in, or rather, you can wherein you can first purchase a house property and then sale off a house property. However, the purchase of a new house property should not be more than a year ago. Then comes Section 54F. Now, Section 54 is targeted in case if you are selling of a house property and investing the gain amount in purchase or construction of another house property. Section 54F is targeted in case you are selling of any long-term asset which is not immovable property. It can be a share, it can be a debenture, it can be a share of foreign company, whatever it may be. And you are investing the amount, the sale proceeds into purchase of a new house property. The time limit is similar to Section 54. However, the area which differs from Section 54 is that you need to invest the entire sum, that is entire sale proceeds, to get the tax deduction in its entirety. If you are investing a prorated amount, you will get tax benefit at a prorated level, right? There has been a new announcement in present budget though. Previously, there was no cap on how much money you can invest. However, from this budget, as per this budget, in case you are uh, gains amount or the investment amount is more than 10 CR, in that case, your capital gains exempted will be capped to 10 CR. Now, section coming to section 54 EC. Uh, Many people may not be interested in purchasing a house property just to save capital gains taxes. For those people, option has been extended by way of section 54 EC. Now, under section 54 AC, if you are selling of a house property and investing the amount in specific bond which has a lock-in period of 5 years, you can avail the exemption. However, the maximum gains that can be saved is 50 lakh rupees. Some of the bonds under this section are Rural Electrification Bond, RECL bonds, National Highway Authority of India or NHAI bonds, Railway Finance Company bonds. Now, these bonds, whenever you are trying to purchase, they will be specified as Section 54 EC bonds, so you may not face any sort of confusion. It is to be noted that all these companies, the companies that I have mentioned, has multiple types of bond, but it also has a specific bond which calls section 54 EC bond. If you are planning to invest the capital gains into these bonds, please make sure you are taking up section 54 AC notified bonds. Now, uh, let's take a look how you can save capital gains taxes in case you are selling off a house. This can be a very real scenario which can happen to any person. Now, if that house property or a flat is held for a period in excess of 24 months, firstly, it will be treated as long-term capital asset. And any gains that you are making out of it, that will be treated as long-term capital gains. Now, since this asset is long-term capital asset, indexation benefit can be applicable, can be taken on purchase price of the house, right? Furthermore, if you have made any sort of improvement which is more than 24 months old, in that case, you can take cost of improvement uh, as cost of acquisition, as a part of cost of acquisition. Further, if they are more than 24 months old, in that case, you can index that cost as well. However, it is to be noted the amount that you are spending to improvement of that house must be for significant purpose, right? For example, there is some small electrical job that you have carried out that will not be taken as cost of improvement. However, if you have redone the complete electrical works of that house property, or if you have done anything which increases the value multifolds on that house property, then it can be treated as cost of improvement, right? Also, it is recommended that you spend the money of this improvement using banking channels or any of the traceable mode, which will actually give you relief in case income tax department raises any queries. Therefore, it is absolutely for your benefit to make payments and keep bills of that improvement with you. Also, at the time of selling, you may incur some brokerage charges or any selling expenses. Those expenses can also be taken as deduction from the capital gains. Further, after considering all these facts, all these figures, you will be left with the net capital gains and you can avail section 54 or 54 EC benefit which can save you some capital gains taxes. Now, in case you are not investing in 54 or 54 EC bonds, what will be the situation for you? Firstly, in case you are not availing the tax exemption under any of this section and you require the money, in that case, you need to pay the taxes if you are not availing the deductions or exemptions. And if you are supposed to pay the taxes, advance tax implication comes into picture. Now, advance tax means if your tax liability after all the TDS claims and TTAA benefits or anything is more than 10,000 rupees in a year, then you are supposed to pay advance taxes. Now, advance taxes need to be paid in a quarter wise manner, and dates of that quarter are 15th of June, 15th of September, 15th of December, and 15th of March during the financial year itself. If you are selling a house property or if you are earning a capital gains in the financial year 22-23, then the date will be 15th of June 2022, 15th of September 2022, 15th of December 2022, and 15th of March 2023. Each quarter, you are supposed to pay 15% or 45% or 75% or 100% of the total tax due, right? So, if the sales actually takes place in the month of April or May, then you are supposed to do a rough tax calculation and you are supposed to pay 15%, 45%, 75%, and 100% of the tax due within the mentioned date. Otherwise, if you are not paying any advance taxes, then at the time of filing the income tax return, you will be subjected to a interest. The interest can be 1% per month under two different sections. If the tax liability is significant, the interest can be of significant amount as well. Now we are at the end of the session, and before we take up any uh, before we take up any questions, uh, right now we are going to talk a little bit about taxation in respect of non-resident. Now, in case assessee is a non-resident individual, a non-resident Indian, and that person is investing in Indian stocks using foreign currency. In that case, that person can avail tax exemption under under a different section that is targeted towards non-resident Indians only and only in case you are purchasing the share using foreign currency. Now, this tax saving exemption works in similar fashion of section 54F, right? Say for example, you have picked a share of Indian listed entity. You are selling off the shares of that Indian listed entity and purchasing shares of another Indian listed entity. If you are investing the total sum, if you are investing the total sum that you have received upon selling those original shares, then you are supposed to pay no taxes. In case you are investing a proportionate amount, then your uh, taxable gains will come down in proportion as well. However, this benefit is extended to non-resident Indians only, and if you are making the investment using foreign currency. Presently, this option is available in IFSC, which is located in Gujarat. Now, let's go to the question answer. Right. If we don't really have any questions, we can call it a day. You are going to wait for another couple of minutes and then we can move ahead. Well, there is an amendment in capital gains. Most definitely, that capital gains has been the amendment has been made in section 54 and 54F. Previously, if you are investing in a new house property under both these, uh, you could have gone ahead for any amount, right? You could have saved any amount of taxes. But as per the amendment, now the investment has been capped to 10 CR. So if the investment is more than 10 CR, you are supposed to pay taxes at the applicable rate, which is in excess of 10 CR. Well, this question is not really related to capital gains, but yes, presumptive tax benefit is still available under the new tax regime. Right. So we are going to conclude our session right now. Thanks for joining with us. I hope you have taken away some understanding of capital gains and capital gains taxes and how you can save the tax on capital gains. Thanks for joining with us. Have a great day. Bye bye.